about the situation right now is that we are at a point where numbers really matter. In other words, we are at a point where there's so much negativity around Tesla that we can be almost sure that there's no hot air left in the stock. What's left in the stock now is pure fundamentals. Demand, price, product, margins, typical business fundamentals. You're making something, you're selling it, you're making a profit, or you're not making a profit. Questions like that, which that's what we call fundamentals in the investment world, matter now. All the hot air, the potential, the Elon Musk factor, the impossible. About a year ago, I had an episode on this podcast series where I spoke about the fact that sometimes, like, we humans are not good at understanding exponential growth, and therefore we need to understand that valuations might look absurd to us right now, and then they might make sense in the future. Well, they didn't make sense back then. They were absurd, and that was the peak of Tesla and the peak of our fund, and now we're down almost 60% since then. And this is the lesson we learn as investors, that sometimes when things look absurd, then they probably are absurd. And when things look scary, when things look less absurd and more fundamentally driven, or in other words, when you really start thinking about the numbers, then that maybe there's a silver lining here, that you're in a situation where at least the hot air is gone. And that is the situation we're in right now. Talk about the numbers. Let's talk about the fundamentals of Tesla. Let's talk about where we stand as investors, what we're doing right now, and how we prepare ourselves for the coming period. This is not even a long podcast. It's December 12th, 2022. This is Krim Delco for the year. We're down 60.5%. The market is down 16.3%. We're underperforming by 44.2%. Now let's get right to the point. Tesla sold off another 6% today. Like I said, we're down 60% for the year. And the reason we're down so much is primarily due to Tesla. There are some macro reasons, the higher interest rates and the sell-off in the market and the sell-off of risky stocks and all of that. But we really want to focus on Tesla in this episode because this is where most of our energy is going right now. The purpose of this podcast series is to give people a sense for what it feels like to run a hedge fund. Well, this is how it feels like when you're down, when you're in trouble, when you have to justify to yourself and your investors that you still have a reason to be in this business, even though you lost so much money and even though you've really underperformed pretty much any metric that matters in this business. So what has happened and why are we in this situation? Well, we are long Tesla by a long shot, meaning we have most of our capital in Tesla. And the reason we stayed invested in Tesla and haven't diversified is because we believe that diversification is not a good idea, that our cost of capital is the best possible stock that we invest in, that our discretion is really around buying a stock and then staying invested as long as we can, and that the only thing we should be managing is leverage. This has been our situation for the last, let's say, almost 1 year. This is how we were thinking about our investment, about our strategy. We're at a point right now where unfortunately things have become a little bit absurd because Elon Musk, the CEO and founder of Tesla, is doing things that are, well, let's say that just aren't sort of normal when it comes to running a business. And when I say that, I really mean that, sort of even calibrating for Elon Musk, because we were under the impression that as a CEO and founder of Tesla, he has the best intentions to drive up the value of Tesla because that is the best way he can accomplish the mission. Unfortunately, what he's doing now with Twitter is kind of putting that a little bit in an orthogonal space. So we're not sure, is he really, does he have the best interest of Tesla in mind here, or what's going on? Because the political ramifications of what he's doing with Twitter are becoming more and more prevalent. Now, having said that, we completely agree with almost everything he's doing. We agree with, let's say, his attack to the society being forced to use pronouns all of a sudden, which is sort of a collectivist approach towards suppressing people's freedom. We agree with him, calling for a deeper investigation or a prosecution of Dr. Fauci, just because Fauci has been overstepping his powers and really created lots of damage by spending $5 trillion on pseudo measures for what he and his people called sort of COVID measures, which at this point you just have to sort of summarize in a COVIDian charade. And all of these calls are right, and they make sense. Unfortunately, this should be coming from elsewhere, from media, from maybe from politicians or other CEOs in collaboration, but not just from one person. Having said that, the lack of support on particularly from the side of Republican politicians is shocking, because if the Republicans really wanted to be a counterbalance to this collectivist woke charade that we're exposed to right now in politics, well, why aren't they supporting the one voice, which is the voice of sanity? So Tesla and Elon Musk are kind of left alone, and us shareholders of Tesla, we're the involuntary freedom fighters here. We're the we're the conscripted army that is fighting this war of freedom against collectivist nature, the collectivist nature of U.S. society right now. So having said that, now this is all manifesting itself through Elon Musk's ownership of Twitter, and that and this was probably a bit of a Freudian mistake that I made, because Tesla and Twitter unfortunately are intertwined right now. Well, anyway, what we're feeling that in the stock of Tesla today. Tesla is down 6% with the market actually up. So I couldn't see any specific news. I mean, they're lowering prices in the U.S. They're giving credits for people buying a car and things like that. So demand is definitely being hit. There is a risk of a slowdown in demand, maybe a slowdown of growth. I don't think the risk of actually negative growth is prevalent, but a risk of a slowdown in growth is definitely more accurate, a more accurate description of what's going on with Tesla right now. So having said all of that, now what really matters in situations like that as investors is the numbers. When all the hot air is out of a situation, when all the strategic sort of long-term visionary type arguments are thrown out of the window, what's left is the numbers. What's left is just pure fundamentals, and let's focus on the business and not so much on valuation. So the business, Tesla, is probably going to be around 1.3 to 1.4 million cars this year. We expect this to be at sort of translate into about 80 billion in sales and something between 8 and 10 billion in net profit. So we're looking at something around 3 to 350 per share in terms of EPS. So having said that, that gives you about a 50 times earnings this year. It gives you about about 7 times sales. So this is still a pretty steep valuation for any kind of company. Now, this being Tesla, of course, you have to look at it from different perspectives. Tesla has an enormous moat in data and AI, so the potential for value creation through full self-driving is enormous. We also have demand for their cars, we have demand for Cybertruck, we have demand for semis. So all of these things are in place, and given that we did 1.35 million cars, or we expect to do about 1.35 million cars this year, we are expecting to do something between 1.7 and 2 million cars next year. And given that growth, that puts us at something in the range of 100 to 120 billion in sales, potentially. Let's be conservative, 100 at 10% puts you about 10 billion in net revenue. So there is a potential that EPS could be flat to only a little bit of growth. And that's probably what's being priced in the stock right now. So this is a risk that is priced in the stock. Probably there's another 10 to 20% downside. But if this scenario kicks in, we believe that there isn't that much downside left in the stock. Now, there is potentially more downside, that we have even a further decline of demand, that we have a further deterioration of margins like we had a couple of years ago when there was this demand pocket and pricing was all over the place. And we're kind of in a similar situation. Pricing's all over the place. news of slowdown of production, news of slowdown here, slowdown there. All of these kinds of things are weighing on the stock, and we have to take this seriously as investors. But what's the purpose of this exercise today is not to sort of calm down the waters and convince people that Tesla's still good investment or any of that stuff. What the purpose of this, when we go through the numbers, when we really focus on the fundamentals, is just to understand, okay, what is the bare bone value of this stock? There is value in this company. This is not zero. So where is it? And the value of the company doing these types of measures, when you do this type of measure, then you also force yourself to really, really dig deep into your soul and ask yourself, well, look, what is this really, really worth? And I think what Tesla is really worth, given all of this now, given the fundamentals, let's say you do 100 billion in sales, you do 10 billion in sort of net earnings, you can then, reasonably assume that this is worth something around maybe 300 billion in market cap. So which is another, easily 40% downside from here. So this is what it is. I mean, I'm not making this up or trying to be a bear or shorting the stock. I'm just saying, look, I think 300 billion is a absolutely reasonable valuation for Tesla, given all the problems that the company is facing. Now, having said that, look, the company was 1.2 trillion not too long ago. So from 1.2, it is 530 now. So we're on that path to 300 billion. I hope we don't get there. It will be strenuous for us and the fund, but that's kind of where we live. And that's 40% downside from here. So from 500 to 300, that's roughly 40%. Yeah, more or less exactly 40%. So that's where we live. $160, 40% of $160 would be about something around $100. So the $100 downside is, that's where we think Tesla has definitely a floor in terms of value investors coming in and buying the stock. So they're not going to buy the stock now, but they're definitely going to buy the stock at $100 a share. The good news is that gives us a little bit of a floor also in terms of where this can go. I mean, it's almost like having a put on the stock at $100. Let me now give a little bit of a more big picture perspective on the situation here. Unfortunately, the situation is absurd. The situation is absurd because the CEO and founder of Tesla, the company that we're invested in, is spending his time with other things, doing other things that he seems to be more interested in. And that leads us to the conclusion that he doesn't want to be CEO anymore. So I think at this point, it's actually good news, because the question should he be CEO? Who should run Tesla? This question is now becoming more crystallized. It's becoming more sharpened. And I think we're looking at a solution pretty quickly. What I mean is maybe in the next couple of weeks, maybe even sooner, that we will have the announcement of an administrative CEO for Tesla, and therefore at least the day-to-day business of Tesla being in control of a person or of some sort of institutionalized position that then reports to the board, and the shareholders have a point of reference, and all of these things are very important. So to summarize, we're in a very tough spot today as investors. We're underperforming the market by a long shot. The reason we underperform is because Tesla is underperforming and it's our largest position. The reason we're long Tesla is because the company has a lot of potential in transforming the energy, transportation, and artificial intelligence markets, robotics markets, excuse me. And that is still a beautiful thesis. There's still a beautiful reason to be invested. But we also have headwinds, in particular the absurdity of the CEO doing other things than running the companies. That leads us to two conclusions. One is we have to find a fundamental value of the company, a value where the company is, where sort of the valuation of the company finds a floor. And then we also have to, and the good news is that we also have to think and expect an announcement pretty soon about a CEO replacement, or at least an administrative CEO, so an institutional position where somebody's in charge of the day-to-day business. That is good news, because then this overhang will be solved. We also believe that Tesla and Elon Musk can, in conjunction, still disrupt many markets, in particular the AI market, the transportation and energy markets. But nevertheless, there's a little bit of a hiccup here, and that's why there is this sell-off right now in the market. So the good news is that we understand why it's happening, and we also have a certain feeling for where the valuation of the stock can go in if you put a bottom on this, or if you put a line where you can say, look, this is what this company is worth when there's absolutely no hot air and nothing. Right now, there's still something left, hot air, expectations, vision. These things can change. We could be a couple of months from now talking about vision and the Cybertruck being the next big thing, and all of these things could change very quickly. But right now we're at bare bones. We're at the fundamental base of the company, which is 300 billion in market cap, about 40% downside for the year. This is where we see the absolute sort of value investor coming in type of valuation of Tesla. Thank you.